Welcome. We're joined today by Andrew Wolfson, the CEO and CIO of Pembroke. Welcome, Andrew.
Thank you, Seb.
So we're here today to talk about Pembroke. Maybe we should take a little bit of a step back to begin, and it'd be great to understand about the history, where you began, what your team did, what you did, and where you are now.
Gosh, how far back would you like me to go? I mean, I can go all the way back to when I didn't go to university, which was back in the day. It was the thing to do. I went to university actually for a day and realized I didn't want to be there, and left much to my parents' anguish, and went off and became, I guess, an entrepreneur, which back in the day, if you didn't have a profession, your only way of getting a job was to go off and do something on your own. So I went and ran a tennis and golf hotel, went into mobile phone manufacturing, acrylic furniture manufacturing, tried a number of things. Had some successes, some failures, which was a good thing. And then in 2007, I got married, had a baby, and then 2008 came. And I was sitting in an office with 3 businesses, and I was faced by financial meltdown going on. And I actually went to talk to an Israeli friend of mine and about what I should do with these businesses. And he turned around, as only an Israeli could, and he said, close them down. And I thought, what's genius? Why didn't I think of that? And so actually, I stopped spending my own money, hemorrhaging my own money, supporting these businesses, and I went to work for Peter Dubins, who I'd worked back when I was 20 years old. Went to work for Peter of Oakley Capital, and looking after his private investments, one of which was Tom Aiken's restaurants that he bought out of administration. And I started running the restaurants, and then slowly more and more young founders came into Peter's office looking for his advice and funding. And in 2013, we decided to set up a VCT so that we had a formal structure to fund the opportunities that were coming in.
Well, fascinating.
That's really how it started.
Yeah, and there's been some pretty substantial growth over that time from when you began. But maybe you could tell us a little bit about the model, like what stage, sector focus do you guys have, and how much money do you currently manage?
So at the moment, we've got 47 investments, soon to be 49. We've got 200 million under management. And I think it's very difficult to say what do we invest in and at what stage we invest in, because we look at every opportunity as a unique opportunity to work with a new founder and management team in a way that we don't work with other people. If it was really easy and we had a script as to what we did, everyone would be doing it. So we're very much about people. The stage we say we like getting involved at, but there are always situations that break the rules, is roughly $1 million of annualized revenue. And we like businesses that focus on margin, that have a product that they sell, whether that be a SaaS product that they're selling into business or whether it's a physical product that they're selling to a consumer. It doesn't really matter. Business is business. And I think sometimes we overcomplicate it. And what we like to do is to look at what the product that someone's selling is, what margins do they sell at, and how scalable do we think it is. And really focus on who the founders are. Can we work with them? One of the things that we really don't like, or I really don't like, some of my team do, is 5-year business plans. Because the only thing a 5-year business plan says is that someone can build a financial model. But all it does is extrapolate what they know at that moment in time out in a way that is going to look impressive to investors. And they're going to have a company that's, doing £100 million in 5 years' time. If they don't focus on the first year, they're not going to get to the 5th year.
Yeah.
So what we like to do is back founders who look at the next 12 to 18 months of growth and really focus their team on delivering that. The other thing, of course, that we like is backing people who are willing to take advantage of opportunity as and when it presents itself. And unless you have a crystal ball, you can't write a business plan that looks at forward opportunity, because you'd be daft to do that. So we like to back people who really do deliver on 12 months. We know that if a company does better than expected, it's going to require more funding. And if a company does worse than expected, it's going to require more funding. So every business we invest in is probably going to need more funding. And what we like to do is invest in companies in very much a stepping stone way, where we back a period of growth and try and wrap the right people around the founders and management teams so that it slightly de-risks the business.
I guess you've sort of touched on the next thing I was going to ask, which was the £1 million annualized revenue mark, often called Series A, I guess, in the sort of terminology of the VC world. There are lots of investors there. And why would you say you're different to other funds? And you mentioned this wraparound stepstone approach, but maybe particularly that, why do your founders say they pick Pembroke?
Best to ask them. I mean, one of the things that everyone says is that they're founder friendly.
Yeah.
We like to think that we stand as a point of difference to the market in that when we back a company, we invest in the same equity that the founder has. We don't have preferential rights. We think that sets us apart from the founder. We want the founder to get wealthy. If the founder gets wealthy, our investors get a good return. So we don't like to put in kind of slightly complicated investing parameters for us to back our founder. I think the other thing is that we don't take any fees out of our founder-led businesses. And the reason we don't do that is that we obviously, like everyone else, charge an annual management fee. But if you're backing a pre-profitable business, if that company is paying you a fee, then that's just our investors paying us more money. And the founder is being diluted by paying us more money. So founders like working with us because we encourage them, when we first meet them, not to over-raise, but to raise at a sensible valuation, a small amount of money, and prove the next stage of the business. So we don't look at pre-seed, seed, Series A, Series B, because these are all just numbers that actually no one has really explained what they are. They seem to be more to do with an amount of money being raised rather than a stage that the business is at.
And when you're looking at the portfolio, and you talked about the stepping stone approach and the funding, what is it that you do when you said the wraparound support? What is it you do to help them succeed?
So one of the things we do, and people often ask us, what do we do for founders? And I say, whatever founders want us to do, because we are not prescriptive. So we sort of like to get a list from the founders during the sort of due diligence phase and the 100-day plan when we're invested. We really work with the founders management team to see what we can do for them, whether that be getting in industry experience non-execs, whether it be modeling out their cash flow, whether it be introducing them to new digital agencies, or helping them recruit people into the right roles. There's this big thing in recruitment or in founder-led businesses that you've got to bulk up on C-suite. But just because someone has had a big job at another firm doesn't mean they're going to come into your business and hit the ground running. Maybe they've been really good in their other firm because there were a whole load of people below them who were actually doing the work and they were taking the credit for it. So there's this sort of thing as to how can you make sure you employ the right people? And we get very involved with trying to get really good people in the business and persuading founders that it doesn't really matter what the salary is, because if you get someone really good, they will do more than save you that salary.
And you talked about the size of the portfolio and you're helping. How many investments do you tend to make per year, and how diversified should an investor into the VCT this year expect their portfolio to be?
So anyone coming in gets obviously exposure to the 48 companies that we've got. We very much look at deploying our capital in 30% in new businesses and the rest in follow-ons. Yeah. So businesses that we've backed over the last 3 years continue to consume cash, albeit at hopefully higher valuations and better business models and strategies. So we would look at putting 2/3 into our current portfolio and 1/3 into new, which roughly means making 10 to 12 new investments a year. And we get over 2,000 approaches. So my investment team really do sort of double down on who are the very best of them.
Yeah. And talking about that 2,000, there's got to be a lot of work there filtering through them. How do they come to you? Like, how do you get them through the door? And what is it that gives you the edge there? How do you get those 2,000?
It's not so much how do we get the 2,000s, it's how do we get the good ones. Yeah. And that's really what matters. Are we getting good ones, or is just everyone bashing out emails to us? And a lot of us, our time is spent sorting through opportunities that we definitely can't invest in. So we actually get a lot of opportunities from abroad where people clearly haven't read our website because we can't invest in non-UK businesses. But I think one of the things we do, which a lot of other funds I think don't do, is we see businesses well before we are going to invest in them. So coat paints, for instance, we first saw them when they just launched. They had very, very small revenues. And we said, look, in order for us to invest in you, we would want you to be of this size monthly revenue and have a few more employees on board, et cetera, et cetera. They actually came back within 3 months and said, okay, with that. But a lot of people wouldn't have even seen them at that first port of call because they'd have just said too small, don't see them. So we look at nurturing potential opportunities by seeing a lot of people much earlier than other funds of our size would do.
And so how do you build the conviction in the companies? What is it you're looking for? You talked about how you invest more in teams than in sectors. And when you're looking at those 2,000, you're getting that chance to speak to the good ones earlier. What is it you're looking for? What is it that makes you tip over the edge into that's the deal I'm going to do?
I would say a lot of it comes down to the founders' understanding of what they're trying to do, the blue sky thinking that they have, tempered with, I want to build a big business that has a responsibility for spending cash in the right way. And one of the things we're seeing now, it's very interesting, never before has the opportunity to be an entrepreneur been, I think, as relevant and as easy as it is today. And what we're seeing is not so much people straight out of university saying, I want to be an entrepreneur. What we're seeing now is this really strange dynamic of people leaving university and seeing their 20s as a fairly transient, working experience. They go from one company to another. They're head of people in one company, they're digital director in another, and they're gathering all these skill sets so that when they hit their late 20s or their 30s, they really know what they want to do. And then they use crowdfunding platforms, they use LinkedIn, they use shared workspace providers to go and set up offices. And what we're seeing is people coming out of large businesses. The people who would years ago have been the innovators within large businesses, they're leaving large businesses. So a lot of our Packwater brands, Sam was in a food delivery business and came out of it, said, I think I've got a better way of doing this or a different way of doing it. Coat paints, Rob used to work in the paint world. Sidar was as a surgeon, Tom, who realized that he was losing people on operating tables because he didn't have the right equipment to operate with. He didn't have the right wherewithal. So these are people who understand really what the problem is. They know what the solution is. Whether they can build a big business out of that is the risk. Yeah. But they're not people who've been management consultants and said, I think I've got a good idea. Yeah. It works on paper, therefore we'll do it. It's people who really deeply understand what the industry needs and how industries that have been poorly served by tech are now using tech to change the way the large incumbents do business.
So Pembroke, as you say, is well known for its approach to investing, not just in the terms you give, which are simpler than a lot of the other funds in the market and more straightforward, founder-friendly, but also the stepping stone approach to investing. So since you've invested, how's the fund performed? Have you had many exits that you can talk about?
Yes, last year we had 3 exits, and they were all very different shape. Plenish, which was one of our very first investments back in 2014, where we backed a young lady called Cara Rosen who wanted to get into cold press juicing, which was the rage at the time in the States. We backed her when she was doing, I think she was doing £8,000 a month in revenue, making food in her kitchen or cold press juicing in her kitchen and delivering it around London. And we exited in 2021 to Britvic, making a 2.3 times return on money. And with her, we had done this stepping stone investing where we just continually backed her along the way, really putting our faith in her as a founder in a market that we thought was going to, explode in the UK. The problem with cold pressed juice, and this is another thing that we like in our founders, as I said, cold pressed juice may sell in wealthy areas of the southeast and a few other pockets around the UK, but it's not a mass market UK product. Cara realized that relatively early on, went into nut milks, and it was the nut milk part of the business that Britvic liked, and they wanted to.
That many people that are listening today might have heard of, or maybe even drunk, Plenish.
I hope so. Very good stuff. And then Pastor Evangelist was another hospitality business, a food business we backed, where, funnily enough, with Alex Savelli, the founder of it, had come to see us a few times and before we invested. And he had a brand that he was pure D2C, we're going to deliver past through the door. And we're like, if D2C doesn't work, which we're finding now, what's your omni-channel strategy? We said, until you get an omni-channel strategy, we can't invest, because if it doesn't work, it's too obvious, it's too big a risk. So he came back to us with an omni-channel strategy where he'd done a deal with Marks and Spencer, he was going in there, he'd done a deal with Selfridges, he was doing one with Harrods, for physical sites. And we thought that's a way of driving eyeballs and acquiring customers who will then become digital customers. That was back in December 19. January, February 20, COVID hit. Obviously, all the physical sites shut down. Online food delivery went through the roof. Business did unbelievably well. And within a year of investing, we'd been bought by Barilla, where Alex is still working with Barilla, and the business is doing fantastically, continuing along the line of digital direct-to-consumer and omni-channel physical spaces. Our last investment, which we invested in ME+EM in 2015. It was a premium ladies fashion business. And we really liked it from day one when we met Claire, when her business was doing, I think, 4 million a year when we invested. But she really understood who her customer was, really understood it, and never had product failures. Every season, she just delivered time after time after time. COVID hit, and the slightly over pessimistic finance director, who's a good friend of mine, turned around and said, "Oh my God, disaster! We're not going to sell anything. Our shops are shut. All our retailers are shut. People aren't going to buy clothes. We're going to need large investor support to keep the business going." How wrong he was. They absolutely nailed it during COVID. They realized that the consumer was still there to buy clothes, but they wouldn't buy work clothes and they wouldn't buy going out clothes. But people still buy clothes. So they did fantastically well over sort of 2020, 2021. And we exited our position in March last year. March this year, returning a 16 times return on our initial investment.
Yeah, that's brilliant. That's brilliant. And another thing that Pembroke's well known for is that you don't shy away from failures, do you? A lot of conversations you have are around discussing failures in the portfolio and the learnings from them. Could you talk us through some of those?
I think, though, before I talk you through some of them, there is this concept, and we seem to be driving this sort of belief in children that you shouldn't fail. And exam results, everyone has to pass, and we've got these league tables. Actually, the reality is you can't learn unless you fail. And, I've got children of various ages. People do really learn, and people learn in business through the failures that they've had, whether they be small failures or big failures. But people do fail, and we've got to embrace failure as what are we going to learn out of it. So we don't shy away from our failures. And I think all too often we hear about funds that have backed these amazing businesses, but they don't talk about the ones that go wrong. And you're either a genius or there's some other thing going on. But we always have learnings out of our failures, and we've had some this year. They are generally about team. More often than not, it's about backing the right people who you can really work with, because things will not go to plan. And when they don't go to plan, as soon as you fall out, you have different strategies and different ideas that founders and their management teams won't even embrace and listen to. Then there are problems. Sometimes it's just not the right product market fit. But there's always an opportunity for me and the team to learn through things that haven't worked. And very often, people who fail the first time go on to build successful businesses. So it's not a bad thing. I think failure should be embraced slightly more, although we don't encourage a lot of it within our portfolio. It's not something that we're going to shy away from. And if we did shy away from it, we would be propping up businesses because we didn't want to take the failure. And sometimes you have to turn around and take the really tough decision, having tried really hard, that actually it won't work and we can't put more money into it.
Now, if we have a look and take a step back, we're sitting here at the tail end of 2022. It's definitely been an interesting year. 2020 and 2021, as you highlighted with your portfolio companies, were better years than people expected, given COVID. But this year has been a bit different. The public markets are obviously down. That has had an impact on later stage venture capital valuations, and interest rates are rising around the world. What do you think that's going to do to your portfolio? Have you had any adjustments to NAV in light of the changing environment? And where do you think the new normal will be?
It was John Galbraith, the Harvard economist, who once turned around and said there are two types of forecasters: those who don't know and those who don't know they don't know. So where we're going to be, I have absolutely no idea. What I do know is that the way we work with our founders and management teams is about the here and now. So we focus very much on the current. We focus very much on making sure cash flow runway is strong. There's this slightly different dynamic now, is that companies have realized that they're now permanently fundraising. And they're not doing it by permanently being on a roadshow. But what they're doing is they are, and we're very much encouraging it, people who funds that turn around when they're going out to raise money, who say, you're a bit small at the moment, come back and see us when you're a bit bigger. We're now not waiting until we go out and fundraise. We're keeping in touch with them. We're saying, here's our numbers, we're beating them. What's actually starting to happen is that people are offering term sheets outside of fundraising cycles because they see that a business is doing well. So I think there's been a shift in the way founders are looking at raising money. I don't think it's a case of we're an early stage business, we want to raise 5 million. I think people have got wise to that. You don't need 5 million. Having 5 million pounds of money where you haven't got a use for it, to us is an inherent risk. So I think that good businesses will always be good businesses, and there will always be opportunity for them. And certainly what we're seeing now with our portfolio, we've got some that find it difficult, that, supply chain, there's been increases. But you know what? We're doing what all the big brands are doing. You're having to pass on some of that cost increase onto the consumer. That's going to happen. So it's not just small businesses, it's not just big businesses, it's everyone that's in the same boat. And I think good businesses, as have always been proven, 50% of the businesses in the Fortune 500 were created in recessions or economic downturns. You can still build great businesses. And that's really about the people and the teams that they build, and having sensible metrics rather than growth at all cost. If you run out of money now, that's the big thing for a business. You run out of money without having your current investors willing to put more money in, it's unlikely anyone else will turn around and look at the opportunity.
So some of the investors that use the Further platform are investing in venture capital for the first time. They're sophisticated, they've been doing lots of other investing, but VC is new to them. Why should they be investing in venture capital rather than the stock market, art, crypto, other asset classes?
I think, they can invest in other asset classes if they want. I think the stock market, it's a bit of a roller coaster at the moment, but if you're long-term hold, it's fine. Crypto and NFTs and all that sort of stuff, I don't understand. We'll certainly never be backing it. Those that know, and it's an area that I don't understand. But I think when we look at venture capitalists, everyone likes early stage businesses, and everyone likes feeling a part of their growth. And the great thing about us, I even with my children, when we were investors in Plenish, and I still do it actually, when I walk around the supermarket with them, they used to count the number of bottles on the shelves for, brands that we were investing in, Rubies in the Rubber. You feel like you're part of the growth of, UK PLC. And it's really lovely to feel that, when you go into a supermarket or you're seeing something on, you're sitting down and watching a movie and you see a company that you're invested in advertising, it's got that feel-good factor to it that you're helping build new businesses. And you don't really feel that with the stock market. I don't think you really feel it with crypto. And the nice thing about VCT is that your risk is spread over the entire portfolio. So if you're a new investor now, you get access to everything that our current investors have funded, albeit at a slightly higher NAV. But our current investors have funded the investments in those businesses. So it I think is a very good way of balancing out a portfolio.
Yeah. And specifically, if somebody's looking at VC, they could invest in a fund, or they could go do angel investing or crowdfunding. What do you think differentiates professional management from those options?
It's a difficult one without being rude to other people, but the amount of work we go through to choose the businesses that we invest in, I think is way and above what any individual would go through. So we like to think that we, to a certain extent, de-risk some of the risky investing that goes on. The other thing is that a number of our investors, sort of high net worth investors, when they've got an opportunity, one of their friends' children wants some money to start a business, they very often send it to us and say, if you invest, I'll invest alongside you, but you carry out the due diligence. So, most people aren't set up with a team of people to go over the numbers, and due diligence really takes us, 2 months to do. If you go onto a crowdfunding platform, I think because most people don't put in large amounts of money, it becomes, it's a new way it's sort of the new Ladbrokes. There are some that will do really well, and there are some that won't do well. But I think the thought process is not quite the same when you're investing £50 as when you're investing in a VCT and then spreading that risk across a number of companies.
Sure, yeah. To round up then, you've touched on there quite extensively why a VCT, but why Pembroke if they're comparing other VCTs?
We think we do what it says on the tin. We back early stage businesses, we back founders, we back management teams, we back them on friendly terms, and we really work with them to help them grow their businesses. It doesn't always work out, but I think when you look at our annual report or our half-yearly report, you look at the detail we go into with our companies. Most of the founders I've got on speed dial, and I call them and have conversations with them. I don't wait for board meetings. We actually genuinely like the businesses that we invest in and want them to do well because we enjoy them.
Great, thanks Andrew. If you'd like to learn more about Pembroke, then check out the fund page that you're on right now. And if you've got any questions, then use the live chat or the email function to get in touch with us. Thanks.